Warren Buffett, the Oracle of Omaha, turned a measly $11 from a childhood paper route into a cool $114.5 billion. But he did it by investing smartly, starting with small sums.
You went back to that day in 1942 because it was the day you purchased your first stock, which point out you were 11 years old then.
Right.
Now, you might be thinking, great, another rags to riches story. How does that help me with my measly $1,000? In this video, we are about to share his 5 golden steps to turning that $1,000 into a cash-generating monster. So keep watching, and don't forget to subscribe first. Let's begin by discussing the scenario of having only $1,000 for investment, implying placing it somewhere and allowing it to grow. So you've accumulated $1,000 and are contemplating investing it in the stock market or potentially riskier assets. First off, congratulations on reaching this point, as you've already accomplished more than the majority. You've successfully saved that $1,000. However, I must convey some less favorable news. Opting for the stock market might not be the most prudent choice if this $1,000 represents your only investment for the foreseeable future. Consider an example. Suppose the year you invest your funds witnesses a significant upswing in the stock market, yielding a remarkable 25% return, surpassing the average by 15%. Seasoned investors would typically celebrate such returns. However, if your investment amounts to just $1,000, the resulting return of $250, though impressive in percentage terms, may not significantly impact your life. The relative gain might not be substantial considering the invested amount. One might ponder whether a safer bet would be placing funds in a savings account or CD, given their guaranteed returns. Let's examine this option. As of January 2024, the average return from a savings account stands at a meager 0.33%. Consequently, placing your funds in a savings account for 5 years would yield a net total of $1,106. While this approach guarantees returns, it falls short in wealth accumulation over time. How about considering CDs or certificates of deposit? For those unfamiliar, these function like savings accounts with the catch that you can't access the money for a specific period without incurring a substantial fee. Let's examine how this scenario might unfold. The average CD rate for a 5-year term stands at 1.37%, which, while not terrible, doesn't yield significant returns. Your $1,000 would marginally increase to $1,068, enough for a decent pair of jeans or new shoes. However, waiting 5 years for such modest gains may not be appealing. It's not a wealth-building strategy, and even if you were to invest in the stock market over 5 years with an average return of 7%, you'd only end up with $1,400. While this is arguably the best option, it falls short of being a life-changing move. Method 1. Invest in yourself. If you're feeling anxious, there's a practical step you can take to increase your earnings, allowing you to invest more and consequently grow your wealth. Many people underutilize their potential in life, and any investment in self-improvement is the most rewarding. Following your passion, whatever that might be, is crucial. To quote Warren Buffett, the best thing you can do is educate yourself and invest in yourself.
Well, I'll give you 2 pieces of advice. I'd invest as much in myself as you can. I mean, you're your own biggest asset by far. I mean, you've got all kinds of potential. All the people in this room, you're lucky to be in this country, gotten a good education.
This entails acquiring new skills that can prove beneficial for any company you are currently or might work for in the future. The more valuable skills you possess, the higher your earning potential becomes. It's a straightforward concept when viewed in this way. You can enhance your skill set through avenues such as books, webinars, seminars, or courses. The greater your skill diversity, the more likely companies will retain you, reducing the risk of layoffs, as observed nationwide. Examples of viable skills include marketing and coding, both increasingly valuable assets across various industries. Essentially, aim for skills in high demand but possessed by few. A notable quote from Charlie Munger reinforces this idea. Develop into a lifelong self-learner through voracious reading. Cultivate curiosity and strive to become a little wiser every day. The more you learn, the more you grow, and the more you grow, the more your money and happiness will grow. Method 2. Establish passive income sources. Another option for utilizing $1,000 is to focus on establishing an additional income source. The advantage of this era is the ease with which you can create an extra income stream thanks to the internet. The challenge lies in putting in the effort to lift that business off the ground. Yet, if you invest in expanding your knowledge, you can take actionable steps to create something meaningful. The money generated can then be reinvested in your business for further growth. And as it generates more income, you can explore opportunities in the stock market. So if you've got a stable income and have saved up $1,000 and plan to add more money each month, the key is considering what else you can do. As mentioned earlier, even with a consistent income, investing in your education ensures personal growth that will never let you down. The focus here is on seeking a source of passive income. This involves placing your $1,000 along with additional monthly contributions and letting that money generate returns while you continue working and earning for yourself. Warren Buffett's powerful quote emphasizes the significance of having your money work for you. If you don't find a way to make money while you sleep, you will work until you die. Few aspire to work their entire lives, I'm sure. The primary and commonly adopted method to establish a passive income source is through the stock market. However, when referring to the stock market, it's not in the conventional sense. For most people, the stock market provides an avenue to invest in numerous companies such as Tesla, IBM, or Google. When you purchase shares of these or any other companies, you essentially own a small portion of the company. Your earnings are tied to theirs. If they profit, you profit. If they incur losses, you bear those as well. This occurs through fluctuations in the share price or receiving dividends. Method 3. Index funds. The recommended approach to investing in the stock market is through index funds.
On March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the...
Throughout 14 presidencies spanning 7 Republicans and 7 Democrats, enduring such events as World Wars, 9/11, and the Cuban Missile Crisis, the wisdom stands. The most prudent action on March 11, 1942, when I made my inaugural stock purchase, would have been to invest in an index fund. While Warren Buffett strongly advocates this strategy, let's delve into an example for a clearer illustration. Envision allocating all your funds to Tesla. Unexpectedly, all the latest models experience a widespread issue where the car battery stops charging without a clear solution. This leaves numerous drivers unable to use their cars, potentially leading to harmful accidents. Adding to the predicament, there's no feasible fix other than replacing the entire vehicle. Unfortunately, Tesla lacks the financial capacity to replace all affected cars and faces a barrage of lawsuits from injured individuals and insurance companies. Consequently, the company goes bankrupt. Despite having invested in this company and through no fault of your own, you end up losing your entire investment. Conversely, consider a scenario where Tesla successfully develops a battery that charges twice as fast and significantly extends the driving range on a single charge. This innovation propels their sales, causing the value of your investment to double with no signs of slowing down. This dual nature of investing in individual companies is characterized by the potential for substantial returns, but it also carries heightened risk. Making an ill-fated choice can result in the loss of your entire investment. A practical guideline to follow is that if you lack the time to study companies and to delve into investing, it's advisable to steer clear of it altogether. Investing extends beyond selecting the next hyped company, and this is where index funds prove beneficial. Index funds essentially comprise a basket of companies available for investment, eliminating the need to search for the next promising company. Examples include investing in the overall market, a specific sector like tech, or companies offering dividends. The notable advantage is that these companies are straightforward to purchase, as simple as stocks. However, it's crucial to note that investing, even with index funds, doesn't guarantee profits. Always conduct due diligence and avoid blindly following advice. The examples provided are options for potential investments. For beginners, general market funds like VOO and SPY are safe and reliable choices. These funds expose you to the top 500 U.S. companies. Expect the fund to rise with the U.S. economy and decline if the economy falters. For tech enthusiasts, VGT or QQQ are options that expose you to companies like Microsoft, AMD, or Google. Both funds feature different companies, so research to determine your preference. Lastly, for dividend payouts, consider VYM or SDY. Investing in these funds provides exposure to multiple companies that reward you for investing in them. When considering investing in these funds, there's an effective strategy to maximize your returns. The key is to allocate a percentage of each paycheck, around 10 to 15%, directly into your account. This automated approach ensures you earmark money for investing without the risk of accidental spending. As Warren Buffett famously advised, do not save what is left after spending, but spend what is left after saving. Method 4. Invest in real estate. Another avenue for deploying your $1,000 and additional funds is real estate. While it might not be sufficient to purchase a rental house outright, various internet-based options are available. For instance, utilizing a crowdfunding real estate platform enables you to pool your $1,000 with other investors, collectively funding real estate projects. Your returns align with the success of the real estate venture, providing potential gains if property values increase. These platforms primarily yield passive income through rental proceeds. However, it's crucial to recognize that this income isn't easily liquid since it's tied to physical real estate, unlike selling stocks. If you're comfortable with the nuances of investing in physical real estate, lack the capital for property acquisition, and can tolerate the temporary unavailability of your funds, this avenue may suit you. Method 5. Real estate investment trusts. Lastly, indirect access to real estate can be obtained through real estate investment trusts, REITs. By investing in a company focused on real estate, you receive dividends from rental income and other sales without direct involvement in physical properties. REITs often offer higher dividends as they are obligated to distribute 90% of profits to shareholders. Examples of REITs include VNQ and USRT. If you prefer not to engage in investment activities, an alternative is to promptly pay down your debt. You cannot advance in your financial journey by constantly borrowing money at 18 or 20%. Conversely, there's potential to generate significant income by lending money at 18 or 20%, provided you find trustworthy borrowers. However, being consistently in debt is not the path to a thriving life. Settling debt promptly equates to a return on investment. Consider a loan with a 4% interest rate, such as a car, mortgage, or student loan. Clearing it a year ahead means you've essentially earned a 4% return, as that's one additional year without payments to the bank. If you're hesitant about investing in the current stock market or avoiding real estate, prioritizing debt repayment becomes a wise alternative. This approach enhances your available cash by reducing monthly expenses. Rapid debt settlement translates to lower interest payments, allowing you to retain more money in your pocket. So that's all we have for today's video. We will be back with another amazing video for you. Be sure to subscribe to our channel to elevate your finances. Thanks for watching.